Stop marketing IULs to everybody. An IUL is a tool. That is all it is. And if you're marketing an IUL product in the form of death benefit, you're doing a huge disservice to your clients. Let's get into it. If you're looking to learn more about IULs, stay tuned to the end of this video. You're going to learn a lot today. So with an IUL, it is a tool. It is a financial tool, okay? It just happens to be a life insurance policy. There's different types of life insurance policies. There's term. Term is great because it's affordable, gives you the most amount of coverage for the least amount of cost. However, it does end. It expires. And just like car insurance, do you ever see your money back when the policy expires? No, you do not. There is another alternative, however, and I use this for a lot of my clients in mortgage protection because it's a great option regarding mortgage protection because it is a ROP. ROP stands for return of premium. You get your money back at the end of the policy. In some cases, if you have a 30-year mortgage, you can, depending on how long you've had the mortgage and how much the mortgage is, you can get a 20-year return of premium policy, and at the end of the 20 years, potentially pay your mortgage off 5 years early or 7 years early, maybe 10. It depends on how much you have in there. But then you have the permanent life insurance. So permanent life insurance is whole life. It's a GUL, it's a UL, it's an IUL. There's different types of universal life. Okay, whole life is not universal life. Whole life is a permanent life insurance policy. However, whole life policies traditionally they cover you up until you're 100 years of age. Okay, they don't go beyond that. They work off of dividends. They don't work off of indices like an IUL does. And whole life policies don't have something known as living benefits. Whole life policies, you usually have an insurance agent that is upselling you a rider that is an additional cost for the client. It's called a long-term care rider that they attach to the whole life policy. Now, there's so many people out there that are curious about IULs and they want to learn more about IULs. They just don't know who to go to because every insurance agent that they go to the same insurance agent that's doing their bundling for their home, auto, boat, whatever. And those agents are not trained on IULs. They're not certified in IULs. So what they do is they switch gears and they start talking them into a whole life policy instead. Maybe you're not looking to learn more about whole life. You're curious about IUL because you keep hearing it and you keep wondering, well, who do I go to? Who do I talk to? You need to find someone like me, a financial person that is a licensed insurance agent, but specializes in IULs. I am IUL certified. You have to be IUL certified and trained agent in order to sell what's known as indexing product. That's what IUL stands for, Index Universal Life. It's a type of universal life. Okay. So universal life, you have to be very careful because you want to find a fiduciary agent when you're dealing with universal life, any type of universal life. It's different than a whole life or it's different than a term or ROP because of how the agent gets paid. Okay, so you want a fiduciary that is looking out for your best interest because of the way that universal life policies can be structured and built. So the whole purpose that people usually looking at an IUL is they hear this term floating around on social media, infinite banking concept, infinite banking strategy, become your own bank over time, learn how to become your own bank. That's great. It's a great strategy if you can do it. The majority of people cannot do an infinite banking strategy. However, here's the good thing. The good thing is the majority of people can do a LIRP strategy, a life insurance retirement plan. So the way that the policy is structured is any LIRP can potentially become an IBC, an infinite banking concept. It's all in how you're funding the policy, but it has to be structured properly to begin with. So when you're dealing with universal life policies, whether it's a UL, a GUL, which is a guaranteed universal life, or an IUL, an indexing universal life, there's something known as target premium. Target premium may be a term that you are not familiar with. You're familiar with annual premium. Majority of people, when they're thinking about how their agent is getting paid, thinks they're getting paid off of an annual premium. And that is correct when you're dealing with term, ROP, and whole life. However, with universal life, it's different. It's based off of target premium. So the commissions paid to your agent is based off of target premium. Now, target premium, since these are universal policies, target premium can be structured differently, just like the whole policy can. So if you have a indexing policy, if you have a universal life policy and your goal is cash value accumulations, it makes no sense whatsoever for you to have a super high death benefit. You don't want to have $1 million, $2 million, $4 million death benefit with an IUL. It's going to defeat the whole purpose, okay? Because the cost of insurance is going to be significantly higher. The majority of the funds funds that you're funding into that policy is going towards the cost of having that high death benefit. Flip side of that, if you're wanting to build cash value accumulation that you can access tax-free, penalty-free at any age through your IUL policy, you need to have a minimum death benefit to maximize the growth in your policy. However, you don't want just the bare minimum, because then you won't be able to do what's called overfunding. So in the first 7 years of an IUL policy, there's something known as a TAMRA Act. Okay, the TAMRA Act is an IRS tax restriction. What that means is, based off of the death benefit of the policy and how much the policy is being funded with and the age of the client, they come up with this number known as the 7-pay. The 7-pay is a number, it's a restriction by the IRS for how much you can overfund or max fund into the policy over what you're currently doing. If you're doing a monthly, quarterly, or annual contribution, you want that number to be high enough so you can overfund into it, especially if you're using it as a business owner and you're looking for quarterly deductions that you can take. Well, you may, instead of want to go out and buy a Mercedes or a truck or something, you may want to just contribute more to your retirement. Well, you can do that with an IUL as long as it's properly structured. Okay, so you may want a little bit higher death benefit than the absolute minimum, but you want to stay below the annual. Okay, anytime you look at an IUL policy, if you have an IUL policy and you see target premium on the policy is higher than your annual premium, what that means is that agent improperly structured that policy. That policy is at risk of lapsing in your later years because it's going to implode onto itself. Your target premium is something you may or may not see in your illustrations from the carrier, because that's something that the agent normally is the only one that sees. So you may have to ask, just out of curiosity, what would be the target premium number on this illustration that you're showing me to your life insurance agent? And if that target premium is higher than the annual premium, that's a red flag that you should know that agent's making a high commission off of you and your policy, and it's probably going to be improperly structured. They're looking out for their lining of their pockets instead of keeping your family protected and your wealth building and working for you. So when you look at these IUL policies, it's very important for you to ask what the target premium is. Don't be afraid to ask, well, hey, just out of curiosity, how much would you be making off this policy, if you don't mind me asking? And if you have an agent that's actually worth a damn, pardon my French, they're going to show you how they make a commission. I show my clients how they make a commission. If they ask me, hey, just out of curiosity, how much you making off me? Well, this is how our commission breaks down, and I'll show them exactly how it works. I actually walk through my clients how to start and structure their policy from the beginning all the way to the application and the underwriting process. I hold their hand the entire way. That way they know how the policy works, how they access the policy, what it's linked to, how it's built, why it's built that way, why the death benefit is this way, how their living benefits works. It makes no sense whatsoever to get involved in one of these long-term policies if you have no idea how to use it or access it, okay? So make sure you have an agent that is a fiduciary agent that is looking out for your best interest, not their best interest. Now, flip side of that is a lot of these agents out there that claim to be IUL certified or claim to be IUL specialists, they're not. What they do is they don't even know how to structure their policy. They instead market the policy, they market the concept, the strategy idea, but then when they get clients, they call the carrier, have the carrier structure the policy and the illustration for them, and then they send it to the client. Here's a problem in doing that. These carriers, they're hourly employees, okay? And they're captive to that company, to that carrier. So whatever carrier it is, whether it's Mutual of Omaha, National Life Group, North American, Fidelity Guarantee Life, whoever it is, if that agent is relying on them to structure the illustration for the client, well, they didn't have a meeting with that client. They don't know what the client's needs are. They don't know what the client's best interest is. They don't know what the client's goals are with trying to, do that policy. What's the goal with this policy? Is it cash value? Is it retirement? Is it infinite banking? Is it a business deduction? What is the goal in this policy? It has to have a purpose. Well, the person that's structuring that policy from the carrier, being is that they're an hourly employee, they're going to flat rate it at target premium. What that means is they're going to make the target premium and the annual premium the same number. It may increase the death benefit higher than you need. It may make that 7-pay higher than you need. Or you may not have enough coverage in that IUL to protect you and your family. You could need a blended policy, blending a term and an IUL or a whole life and an IUL together, and they may not know that. So they're just going to structure it at a flat rate and send it to your agent. Oh, here's the illustration, and show it to them. There you go. They're hourly employees. They don't know the specifics of your client or about your client or how they should structure that policy. They're just going to structure it straight across the board, target and annual, boom, there it is. And that may not be what you need. Also, it's not going to give you the access to that policy. Okay, you'll hear a lot of people in the comments section and on the TikToks and the videos, IULs are trash because you don't have any access in the beginning years. That's not true. That tells me that it's an improperly structured policy and that agent didn't know what the heck they were doing. Okay, the reason that you don't have access in the beginning years of an IUL is the death benefit is too high. You're not funding the policy properly. Okay, there's two things with an IUL. There's two potential cons. It has to be properly structured and it has to be properly funded. If you're not properly funding the IUL for what it's structured for, like let's say you build an IUL for $400 a month, but you make the death benefit high enough to where every year you can overfund it 20 grand. Well, that's going to increase the death benefit. It's going to increase the 7 pay from the TAMRA Act, from the IRS tax restriction, to $20,000. But now you may not have access in the beginning years on the illustration until year 4 or 5 or 6 because you need to overfund the policy, and the closer you get to that $20,000 mark, the sooner you're going to have the availability to start leveraging that policy. Flip side to that, I mean, if you lower that down, if you lower the death benefit, it's going to lower the 7 pay. And if you're doing $400 a month, you could access and leverage that policy in the first 12, 24 months, depending on how you fund it. If you overfund it, the more you overfund, the sooner you're going to have access and the more you're going to have access to. That's how it works. It's a give and take in these IULs. So it's not just, oh, the IULs are trash because you can't have access to your money. Well, it's an improperly structured policy. That's someone that probably called the carrier and said, hey, just structure this at $400 a month. They structure it at target premium across the board, making the target and the annual the same. And now you don't have access to leverage your money until year 3, 4, or 5, possibly even year 10, depending on how high they make the death benefit. And they're going to look out for their best interest, being as that they're the carrier. So whatever it is, they're going to make sure that the carrier gets their share. Your agent, if it's a true fiduciary agent that you have, they're going to look out for your best interest and not lining their pockets. They're going to look out for, okay, what is the goal of this policy? What are you trying to do? What are you going to use it for? How are you going to fund it? Are you going to overfund it? Is that your plan to overfund it? Is this going to put you into a financial hardship or a financial burden? If this is going to put you into a financial hardship or financial burden, which is why most people can't do an IBC, an infinite banking concept, well, you need to get your income up before you can be able to do this, to overfund it to what you're trying to do. Okay. Now, the cool thing about this is a LERP strategy. You can start it for basic rule of thumb with IULs, whatever age you are, add a 0 to it. That's what you should fund the policy with if you're doing it for a retirement plan. So if you're 35, $350 a month. If you're 40, $400 a month. If you're 50, $500 a month. The reason that it increases is not so much the cost of insurance, but that plays a part of it. It's these things work off of compounding interest. Compound interest takes time. The older you are, the less time you're working with. So the younger you start one of these policies, the more beneficial it is going to be for you, especially if you're going to use it for retirement. Now, the most beautiful thing about this is you have access to your money, tax-free, penalty-free at any age. But at any time, a life insurance retirement plan could become an infinite banking concept, depending on how you're funding it. Now, that 7 pay that I mentioned earlier, that's a 7-year restriction. That's why it's called a 7 pay act. It's a 7-year restriction. After the 7 years, on year 8, 9, 10, 11, and so on of the policy, restriction that's gone, it's over, it's done with. This thing can now become your cash cow, and you can just wash, rinse, and repeat, fund it, overfund it, leverage it, take a loan from yourself, pay it back, don't pay it back. I do recommend you at least pay back the interest, because compound interest is a double-edged sword. It can work for you or it can work against you. But if you're interested in learning, if you want to learn how these policies work, click the link in the bio of the page. Go to LegacyWealthCrusade.com. Check out the website. Check out the informational videos. When you're ready to take that step and you want a one-on-one consultation for free, we don't charge our clients to do this, then click the link in the bio, schedule your consultation, pick a date and a time that works best for you, and have you and your spouse both on the call, okay? Don't be driving down the road. Don't be trying to play, listen. Don't be expecting a phone call. It's going to be a video conference over Zoom. Have you and your spouse together, ready to take notes in a distraction-free area, learn about what it can do do for you, your family, your business, and now you're going to set yourself up for generational wealth for many, 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 many generations to come. People are going to be looking at the picture of you on their fireplace mantle, your great, great, great grandkids, and they're going to be in this big, beautiful house by the lake, and they're going to be saying, we live this way because of great, great, great grandpa or great, great, great grandma, and they set us up and they taught us about these wealth building tools. Nobody else is going to teach your family. You have to start taking the reins and teaching your family, teaching your kids, your grandkids, your great grandkids how to build and sustain wealth without Uncle Sam dipping his hand in your pocket. Best way to do that is with life insurance and annuities, and have everything protected with an estate plan governed by a trust. Learn more about it. Link in the bio. LegacyWealthCrusade.com. Let me have the opportunity to serve you and your family. Look forward to serving you and your family. Have a great day. God bless.